Hello and welcome to Business Incorporated. I am Bisi Adebayo. Coming up on today's program, Moody's says South Africa's loan guarantee scheme will aid financial stability. Tanzania lifts ban on international flights. Plus, Fitch says Nigeria's oil output cuts will weigh on growth and external finances. But first, let's begin with the markets. Now, investor sentiments in major markets in Africa were positive at intraday, with the JSE in South Africa up the most by 0.93%. Here in Nigeria, the main index rose 0.31%, and that was largely due to gains from the banking sector. Egypt's EGX30 also gained at intraday by 0.83%, while Kenya closed positive on Monday. And major Gulf stock markets rose at intraday, taking their cue from gains at global equities on hopes for a coronavirus vaccine, and a rally on oil price continued its rally. Now, Saudi Arabia's index extended its gains for a third straight session, surging 1.78%, boosted mostly by rising banking shares, while the Qatari index rose 0.43%. In the UAE, Dubai's index was up 0.59%, with Emma Properties and Dubai Islamic Bank rising 2.1% and 1.5% respectively, while Abu Dhabi's index rose 0.34%. And in Europe, stocks whipsawed this morning, halting the positive trend set at the start of the week as hopes rise for a coronavirus vaccine. Let's head over to the Frankfurt Stock Exchange, where Chelsea Delany is standing by to tell us more from the European scene. Good afternoon, Chelsea. It's good to see you today. Germany and France have agreed on a €500 billion proposal that would help bolster the European economy after weeks of political fighting throughout the bloc. Will other EU members get on board with the proposal?
Investors are certainly worried that this is going to face opposition on both sides. So coming into this proposal, there had been a lot of pushback from Northern European nations to a joint recovery because a lot of Northern European nations, Germany included, are against the idea of sharing debt. So they don't want to have to issue a joint bond and be responsible for other countries in the EU's their borrowing. But this proposal is sort of supposed to bridge the gap as it proposes a recovery fund that would be funded from the EU. But a lot of EU nations, some of the people who had opposed this are saying that this proposal is just not going to cut it. So Austria, Denmark, Sweden have all come out against this already. And on the other side, even countries that are in support of a joint recovery fund are now saying that this proposal is much too small. It's only about 500 billion euros. Before, a lot of economists said that the EU needed to get together something like 1.5–2 trillion euros. So this is seen as not really going far enough. So the EU leaders are still trying to get this passed, but a lot of investors expect it to be some really difficult negotiations going forward.
Chelsea, let's talk about auto sales now in Europe. They actually plunged 76% in April, and that's amid the coronavirus lockdowns. What countries were the hardest hit?
Well, every country was hit very hard. Pretty much every country saw auto sales at least halved in April. But the hardest hit countries are not surprisingly the ones that have had the strictest lockdown. So Italy, Spain had declines of around 97–98%. Here in Germany, the decline was a little bit less dramatic. It was around 60%, but Germany did have a looser lockdown requirement. But this is certainly an unprecedented decline in auto sales. And even though now the economies are reopening and auto dealerships are reopening, that should help spur a recovery through the rest of the year. A lot of automakers are saying that they're going to need state help to help them overcome just the huge declines they've seen in the past 2 months.
And new data on business confidence has just been released by German think tank ZU. What do the surveys show about investors' outlook for the economy?
Yeah, a bit of a surprise, this data. It showed a pretty steep bounce back in expectations for the economy. So investors seem to be quite optimistic about the path for the German economy. There's two parts of this data. One part is the current, how investors are assessing the current economic situation. That did get worse. So investors are aware that the economic situation is very bad at this moment. But they do seem quite confident that the economy is going to be recovering over the next 6 months. So they seem to be taking a lot of confidence from these reopening measures, the stimulus that the German government has put into the economy, and that's really supporting their outlook on where the economy is going to be at the end of the year.
Many thanks, Chelsea. We'll see you again tomorrow. And in the UK, economic analysts say the labour market is set to worsen as the COVID-19 lockdowns take a toll on unemployment rate. Well, let's cross over to our London studio now, where Juliana Olayinka is standing by to tell us more. Good afternoon, Juliana. So the UK unemployment figure published this morning shows the rate increased by 50,000. Give us details of what this data says about UK labour market and how the markets are reacting to this.
Good afternoon, Bissy. Well, yes, this UK unemployment data shows that the number of people in unemployment is at its highest level since 1996. As of now, 2.1 million individuals are seeking unemployment benefits, and it's the largest month-on-month increase that's dominated headlines here in Britain. It increased by over 70% from the time of March to April by about 850,000 individuals. And it just goes to show how shocking the economic consequence is of the fallout of COVID-19 here in the UK, because we do know that the government have put in so many expansive measures to put and keep people in employment. About 8 million people are now joined into this government furlough scheme where they're subsidising 80% of your wages. And this has been taken up by about 3 million individuals. It's costing the government an estimated £7.5 billion, and that's every single month. So it is shocking and worrying. And as to be expected, even though the FTSE did open with a bright start this morning, it's now in the doldrums at intraday. The FTSE All-Share is down 0.35%. The FTSE 100 is down by 0.55%, and the FTSE 250 slightly up by 0.79%. In currencies, the pound is also slightly up on the US dollar by 0.39%. Down on the euro just by 0.04% and up on the Japanese yen by 0.76%.
Juliana, there's a report stating that young people are the hardest hit by job cuts due to the COVID-19 economic fallout. Does the unemployment data indicate the number of young people that may have been redundant as a result of this pandemic?
It does slightly, and yes, certainly those who are young, those who are women, and those who are over the age of 60 seem to be the worst hit when it comes to the economic fallout. 1 in 3 18 to 24-year-olds are expected to have lost their jobs or will be on the furlough scheme. And one of the reasons is because if you are studying or if you're at university, many of these individuals will be working in part-time in the retail sector, and we know all of those stores are obviously closed, and hospitality. And again, these stores are closed, these bars and restaurants are closed, and they're not expected to be open at least until the end of summer. And that's a key issue here. And what a lot of business bodies are asking the government to do now is to put in at least £1 billion into trying to get these individuals back to work, trying to encourage them to go onto training courses, because there's just been so many job cuts, even within the job seekers allowance and the universal credit system themselves. So a lot of people at the moment are claiming these benefits, but because they're not able to go into the departments to actually speak to individuals, they may be just at home, and there are concerns that people now need to start putting efforts into training and repurposing your skills so that when the economy does start ticking again, you'll be a viable solution to some of the issues that they'll need to be solved. Also, there will be a lot of people that are leaving school and leaving university in the summer. What jobs are they going to go back to, considering we know the employment data has shown that also the number of vacancies that are being put out are decreasing month on month, and the worst is yet to come, some economists say.
And as jobless claims continue to soar, Over Energy, which is Britain's second biggest supplier, says that it will cut 2,600 jobs. How do you think the government will respond to all of this?
Well, the government has responded, Bissy. I think, the British government has spent about 4.5% of GDP on trying to cushion the blow of coronavirus. They spent about £100 billion. That's what's estimated to have been spent. And the Office for Budget Responsibility suggests that Britain may indeed spend about £300 billion. Of course, considering we are one of the worst hit countries in the world, we are spending the most money. But OVO Energy, it's pretty sad. They have announced that they will be releasing about 2,500 jobs. This comes just months after they had a £500 million merger with SSE Energy. And, at the time of that merger, they did say that, jobs will be kept, but alas, they won't be. Jobs will be cut across both of those brands. What they've said is that they're just leapfrogging into their digital transformation. A lot of people now, when they're paying their energy bills, they're not talking to people on the phone. They'd rather do it digitally by going online, which means many of those jobs are redundant. So as unfortunate as they say it is, they said it was inevitable, but they've just springboarded much faster because of coronavirus. Now, there have been a lot of unions that have lashed out at OVO, not just OVO. There are other companies that they're not happy with as well, including British Airways, because, again, many of them have gone onto this furlough scheme. So they're using the government's money, the taxpayers' money, to pay for people to keep their jobs. And as soon as that money is pulled away, they're making them redundant. So now there are calls for the Treasury to stop companies who are furloughing staff to keep them in their positions for at least a year, because otherwise they're just taking taxpayers' money and then chopping them off just when they need their jobs the most.
Thank you, Juliana. I will see you again tomorrow. And stocks in Asia jumped today as hopes rise on a potential coronavirus vaccine after a promising development from Moderna trial. South Korea's Kospi surged 2.25% to close at 1,980.61. In Japan, the Nikkei 225 ended its trading day 1.49% higher, while the Topix index also gained 1.83% to close at 1,486.05. Hong Kong's Hang Seng Index jumped 2.06% as at its final hour of trade, with shares of HSBC soaring about 3.5%. Mainland China's stocks edged higher, with the Shanghai Composite up 0.81% to about 2,898.58, while the Shenzhen Component gained 1.21%. Excuse me. Over in Australia now, the ASX 200 advanced 1.81% to close at 5,559.5. Overall, the MSCI Asia ex-Japan Index rose 1.84%. And in the U.S., stock futures rose today after the market scored its best day in 6 weeks on rising optimism about a coronavirus vaccine. Futures on the Dow Jones Industrial Average rose to 45 points, implying an opening gain of about 230 points, while S&P 500 and Nasdaq 100 futures also pointed to a positive open for the two indexes. The overnight action followed a strong rally on Wall Street that saw the Dow and the S&P 500 both enjoying their biggest one-day gains since April the 6th. And oil prices were mixed earlier today, with Brent pulling back from an early gain on profit-taking, while the U.S. crude extended its rally amid signs that producers are cutting output as promised, just as demand picks up on a resumption of economic activity. Brent crude fell 0.6% to $34.62 a barrel after earlier touching its highest since April the 9th. On the flip side, U.S. WTI crude rose 0.4% to $31.93 a barrel. And at the gold market, prices rose in early trade, underpinned by U.S.-China trade friction and global stimulus, although promising early-stage data for a potential COVID-19 vaccine spurred some risk appetite. Spot gold was up 0.2% at $1,735.83 an ounce, and U.S. gold futures gained 0.3% to $1,739.80. Among other precious metals, palladium slipped 0.3% to $2,006.95 an ounce, platinum fell 1%, $810.12, and silver declined 0.6% to $17.07. When we return in just a moment, we'll look at the domestic commodities market space. Please stay with us. Welcome back. Soybeans are high in protein and a decent source of both carbs and fats, and they're a rich source of various vitamins, minerals, and beneficial plant compounds. The global demand for soybean has been increasing steadily, but like many other commodities, its growth is likely to be punctuated due to the coronavirus effects on the world's largest consumer country, China. To drill down on this, let's talk to Aisat Dawood, a research analyst at the financial derivatives company. Good afternoon, Aisat. Thanks for joining us. What do you think the effect of the coronavirus will be on suppliers of soybean, especially the marginal players like Nigeria?
So, like you said, global demand for soybean has been increasing steadily. However, the pandemic effect on China's economy is of concern because China is the largest consumer of soybean all over the world, followed by United States and Argentina. China consumes about 103 million tons of soybean annually. That's 1/3 of the total soybean consumed all over the world. So if anything happens to the demand growth, China's demand growth, it affects the global demand growth. So this sort of concern. The global demand growth for soya is expected to recover slowly, even if the pandemic effect is still dwelling on the economy. So the global demand for soya is expected to recover slowly by 2%. That's still less than the supply that's currently in the market. That's 353 million tons of demand, which is less than the supply. So this is going to impact suppliers revenue, their income. Marginal players like Nigerian farmers would, they can lose their daily life. So they can even shift from, cultivating soya once they're not seeing it to sell very well in the international market and they're not producing for us because it's producing in small quantity. They can shift to other commodities, and then our production yield of soya would reduce in Nigeria domestically.
Now, looking at the pricing now, in the month of April, soybean prices have traded flat in the range of $350 to $352 per ton. This compared to a 12-month high of $380 per ton. But do you in any way see a recovery in prices anytime so as many countries actually relax the lockdown?
So the price of soybean fell its lowest when WHO declared the virus a pandemic. Given the current demand profile of this commodity, a global recession leads to weaker demand for livestock from livestock producers. So soybean is consumed not just as a meal. It's also used as animal feed in the pig industry, especially in China. China's major consumption goes into the pig industry because it has a lot of nutritious value. So if the demand from China should grow gradually, we should see a gradual recovery in price.
Aisat, let's talk about the demand side now for soybean in Nigeria. Of course, it's been very diversified and it's an important ingredient for animal feed and vegetable oil. Do you think that this demand pattern will insulate Nigerian farmers from global price volatility and protect their income and jobs?
So, here in Nigeria, soybean it has been in existence for a while, but the consumption rate started increasing when people became health conscious. So the growing awareness of the nutritional value that is embedded in soybean has made people or producers, manufacturers to innovate a lot of things. Aside the soya milk that we've known from way back, you have soya flour now, you have soya this, soya that, soya biscuits. So this increasing consumption and the increase in healthy eating, even for the middle income earners, they're beginning to eat healthy. So we should see this as a form of, it's possible to insulate Nigerian farmers from the price volatility in the global market if they decide to produce in more commercial quantity to serve the domestic market.
I'd like to thank you, Aisa Dahoud, research analyst at the FDC, for your contribution. Moody's Rating Agency has applauded South Africa's loan guarantee scheme. According to Moody's, the 200 billion rand initiative introduced by South Africa to keep small and medium-sized businesses from folding due to the coronavirus pandemic will help buffer the country's financial stability. The ratings agency says the scheme has the potential to reduce asset quality deterioration at banks. And Nigeria's compliance with the oil production cut deal led by the Organization of Petroleum Exporting Countries caused deeper economic contraction and fiscal deficits, and that's according to global credit ratings agency Fitch Ratings. The ratings agency says it expects the country's foreign exchange reserves to fall to $23.3 billion by the end of 2020, down from $38.6 billion recorded as at December 2019. Recently, the Minister of State for Petroleum Resources, Timiprit Silva, mentioned that Nigeria will cut production by 417,000 barrels per day to 1.41 million barrels per day in May and June, in addition to condensate production of between 360,000 and 460,000 barrels per day. Last month, OPEC and its partners, led by Russia, a group called OPEC Plus, agreed to cut output by 9.7 million barrels per day in May and June, representing about 10% of global supply. And in Tanzania, the government has reopened its airspace to both scheduled and non-scheduled international flights following its closure last month due to the COVID-19 pandemic. The decision came a day after President John Magufuli directed the Minister of Works, Transport and Communication and his tourism counterpart to allow aircrafts to come into the country. Tanzania Airports Authority and Kilimanjaro Airports Development Company are to ensure that they're well prepared to handle flights into the country. And we wind down in Ethiopia, where Ethiopian Airlines has converted 9 passenger aircraft to cargo operations to boost its capacity in response to the growing demand for cargo shipment. The airline has 12 freighter aircraft operating in full capacity. However, as the need for cargo shipment increases for timely delivery of medical supplies in the wake of the pandemic, additional cargo capacity has become essential.
Ethiopian Airlines has converted its passenger planes to cargo in a bid to help the company diversify and overcome a drastic downturn in passenger revenue. Ethiopian Airlines Chief Executive Officer Tewolde Gebremariam said on Friday, May 15th, that his airline had converted 22 passenger planes to cargo aircraft. Engineers were busy transforming the planes on Friday, with one technician revealing it takes around 36 hours to detach the passenger seats and transform them into cargo planes.
We have been converting passenger aircraft to cargo aircraft. We have converted 20 of them. It depends on the fleet, but it took 36 hours and less. And we have been doing this for the past 2 months.
The demand for cargo had increased mainly due to the demand in Europe and America for personal protective equipment and medical supplies to tackle the virus.
The majority are importers of COVID-19 personal protection equipment and medical supplies. And these are located in Africa, in Europe and America, and particularly Europe in the beginning when the COVID-19 spread was very high.
Ethiopian Airlines has not cancelled any jet purchases so far, despite the collapse in air travel, though several orders, including some from Boeing and Airbus, have been delayed. The airline recorded a loss of $550 million between January and April, but Tewolde ruled out seeking a bailout from the Ethiopian government.
We are a little bit more optimistic. So we see some kind of maybe 50% recovery in the summer because it's a summer peak. And we see that People are sick and tired of the lockdown, as you can see in Europe and America. Governments are opening. Even people are also going out because people were not meant to be locked down.
The global aviation industry has been at a virtual standstill due to the coronavirus pandemic, forcing airlines that were once eager for new jet deliveries to grow their networks to scale back their flying schedules and park lanes.
And that's where we wrap up today's program. Thank you for watching. I am BC Adebayo.